Hello everybody, this is Subbalakshmi, Assistant Professor, Department of Commerce, St. Josephs Arts and Science College for Women, Hosur. In finance, capital asset pricing model is a model used to determine a theoretically appropriate required rate of return of an asset to make decisions about adding assets to a well diversified portfolio. So in the following slides, we will be knowing something about this capital asset pricing model. Capital asset pricing model. The relationship between expected return for asset, especially stocks, and systematic risk or general danger of investing is explained by this capital asset pricing model. One, this financial models shows that the necessary return on an investment and the risk have a linear relationships. The relationship between an asset beta, the risk-free rate, usually the treasury bill rate, and the equity risk premium, that is the expected return on the market less the risk-free rate, is the foundation of this model. So capital asset pricing model reads the relationship between the expected rate for the assets and a systematic risk involved in it. Example of capital asset pricing model. Consider a scenario where an investor is thinking about stock that pays a 3% annual dividend and is currently valued at $100 per share. So if they are going to pay 3% dividend, they are valuing the share to $100. Assume that the stock has a beta of 1.3 relative to market, meaning that it is more volatile than a portfolio that represents the entire market. And this SP, that is the price 500 index, for example. Assume further that the investor believe the market will appreciate by 8% annually and that the risk-free rate is 3%. So how it will be calculated? The capital asset pricing model will be calculated on the following basis. That is 9.5% is equal to 3% plus 1.3 and 8 minus 3, that is annual rate minus the risk-free rate is 3. The anticipated capital gains and dividend of the stock over the anticipated holding period are discounted using the expected return of capital asset pricing model. The stock is fairly valued in relation to risk according to the capital asset pricing formula, and if the discounted value of those further cash flow equals $100. Advantages and disadvantages of capital asset pricing model. The various advantages and disadvantages of capital asset pricing model is that easy to use. It's the first advantage, it can be easily used. Next is diversified portfolio. There are different types of portfolio involved in it, and systematic risk is there. There is always a systematic risk in it. There is two types of risk, systematic risk and unsystematic risk. Business and financial risk variability will be there. There will be a business and financial risk variability. So disadvantages of capital asset pricing model. So what are the disadvantages are risk-free rates tend to change frequently. And the risk-free rate is not realistic factor. It is not a realistic factor. Determining a beta can be challenging. How to determine the beta is a very big challenge. So these are the advantages and disadvantages of capital asset pricing model. And I hope you have learned something about capital asset pricing model. So I'm happy that I was able to share you with this kind of a knowledge. Thank you.